So I call a mortgage company like yourself. What is the first question I should be asking?
I want to get pre-approved. I don't know where to begin. And I say, let's take a deep breath. Let's just talk about you. What do you want? What's your goal? What's your dream? What do you want the payment to be? What do you want? What do you have available for cash? Where do you want to live? And then let me design a plan. And then it's going to be a fluid situation. I'm going to come back and say, here's where you're at. Here's what you could do to get more. Or you're completely thinking in the wrong space. You could actually be buying $200,000 higher than what you were thinking.
Right.
So, but what I want is people to start with me, because if they're looking at $1 million property, but they're only approved for $650, nothing looks good after you've been shopping $1 million properties.
Welcome back to the Just Build Baby studio. You're listening to the BuildX Podcast. I'm your host, Buzz Artiano, and together we'll explore the strategies, techniques, and insights that transform ordinary houses into extraordinary homes. Today we're excited to have Kathleen Caddell in studio with us. Kathleen is a senior mortgage consultant at Fairway Home Mortgage with over 21 years of experience in the financial industry. Mm-hmm. Welcome, Kathleen.
Thank you, Buzz. It's a pleasure to be here.
Yeah, super excited. I know this has been on the books for a while, so glad you could make it. So what I like to do with my guests is start from the beginning, not from the day you were born, obviously, but, maybe post-high school, how you got in this industry, kind of take us up to where you're at today.
Sure. Okay, so we're going all the way back to high school, graduated and attended Marist College in Poughkeepsie, New York.
Okay.
And I was a D1 swimmer for them.
Yeah, I read that. Congratulations.
Yeah,
walk
thank
on.
you. Yes, walk on.
Yeah.
Yes. I had an academic scholarship, not an athletic scholarship. And then when I graduated from there, I was recruited immediately to work for AIG, American International Group.
Sure.
I worked for the domestic U.S. life companies, and I was immediately licensed for life, annuities, long-term care, health, and I was an administrative role initially, and then ended up taking on the SunAmerica Securities broker-dealer division within AIG. As for New England and New York. So I was their regional sales manager.
Okay, so just a small jump.
Small jump. And I was in charge.
Hey, here's this stack.
Yeah.
Enjoy.
And I was in charge of 750 financial planners. Whew. My job was
that hurts just talking about it.
Right?
Yeah.
I was planes, trains, and automobiles, Buzz, and my job was to get them to do business with AIG. They had no obligation to do so, and so my job was to get them to do that. And then the domestic U.S. life company of AIG went and merged with American General, and the domestic U.S. life company was no more. So there were 1,500 employees, and all of them but less than 10 of us were kept. And really it was just for 1 year to try to figure out who our whales were to keep. And so offered another position but decided to leave because I had developed these incredible relationships with these financial planners, and they were not happy with how this had all transpired. And I was their go-to girl to get everything done for them. And they said, we don't want to do business with them anymore, we're mad. So through encouragement actually of several of them, I went and started my own company, Caddell and Associates. And at the same time, my former boss had been let go the year before, and he had started a company called United Benefit Systems and Solutions, and was doing voluntary benefits for employers throughout New England.
So this is pre-Aflac type days?
No, Aflac was there. In fact, Aflac was the competition, and I loved it when we were up against Aflac because I could crush them. So they were so expensive.
Sure.
And their coverage wasn't anywhere near what we could provide. So
it was an easy case-by-case side case, yeah.
So I was doing both. Still working with my financial planners and helping Jim, my former boss, get this up and running. But it was tough. It was tough because when you
this was all remote?
Mm-hmm.
Wow.
This was all remote. So when you are self-employed, the biggest challenge is health insurance when you first start out, because that COBRA is darn expensive and so forth, and you're working on straight commission, and those employee benefit sales, they were happening, but they're very much a long game. So you start the process and you're probably 18 to 24 months before you're getting a paycheck from that.
Really?
So it's tough.
So it takes a long time to build a book of business that you get paid from.
Correct. So it was a struggle. And one of the financial planners that I was working with still consistently tried to recruit me to the mortgage business. He had a mortgage company called First Trust Financial in Weymouth. and he did financial planning as well. He was kind of a one-stop for everything. His name was Pete Thorbon, and he kept trying to recruit me, and I kept saying, Pete, that mortgage world is going to implode, just mark my words. So somehow he convinced me, because things weren't going great financially at the time. Because
sure, and it was a long time from paycheck, sure.
Yes, and the recruiters were still calling to recruit me back into the financial planning,
corporate world.
Be a regional manager.
Yeah.
Lincoln Financial was giving me a job offer, but in Cincinnati. It's
Yeah, you didn't jump at that?
I know. So I almost took it.
We're going to talk.
I almost took it with what they were offering right out of the gate. Yeah, it could solve instant problems, but then long term.
Yeah.
So
and you took a minute and thought about it.
I took a minute, and Pete then had just sold his company to Sallie Mae Home Loans for several million, and suddenly could give me full benefits. And I said, keep talking. So I said, you know what? I'll give it a shot. He goes, just give me 3 months. I'll give you a forgivable draw for 3 months. Just give it. I only needed the draw for the first month. I came in and loved it.
Wow.
Loved it.
All right, so let's break that down a little bit. So a lot of people don't understand what that means. So when you started with him, it's 100% commission.
Correct.
But with benefits.
Correct.
Right?
Yeah.
And so what he said to you was, I'm going to front you 3 months worth of commissions, what I think you're going to earn. And if you don't make it, you won't have to pay me back.
That's exactly right, Buzz. Yeah.
Wow.
Yeah.
Okay, so he really believed in you.
He did. I didn't believe in it as much, but what I loved about it is that coming from and I'll back up, because the concept was, let's have you come in here, we're going to give you an office, and you can do life, annuities, long-term care to every client that comes in. We're going to build this big book of business together. So that's what really got my attention there as well.
So it wasn't just mortgages.
Correct. And then because he had just sold it to Sallie Mae, suddenly we weren't allowed to do anything but mortgages. So that was a game changer. But in the meantime, I had already gotten hooked, because what I loved was that in the financial planning world, with what I was doing, life, annuities, long-term care, I'd meet with a couple and suddenly I had to give them that bad news that, I'm so sorry, but we can't insure you. You're not insurable. It's never going to change. In people's minds, they are doing great. They had a little bit of a heart attack, stroke, cancer, and list of meds, but they're doing great. Yes, you're doing fantastic, but that doesn't mean you're an insurable risk.
Right.
In this side of the business, when someone comes to you for a mortgage, they could have a 400 credit score. It's fixable. I can get them to a yes.
They can't exclude them from health issues.
Correct.
Interesting. That's interesting. I never thought of that, of the rejection on the, especially life insurance side, that you have to tell people you can't get insurance. But on the mortgage side, as you stated, as long as they are pretty much alive and breathing, you can probably get them in some kind
Everything's
of product.
fixable. You can go get a better job. You can make more money. I can teach you what to do financially, which I have to say, for the average American, we don't teach that in school. It should be vital. We don't teach about credit. These kids have no idea, and a lot of times made silly mistakes that they never realized. And back then... It's
funny, though, on a sidebar, though, it's been interesting over, I've had a long career. There have been times when I've had supposed lousy credit because essentially I didn't owe any money to anyone.
Yes, that is a valid problem. Yes, you have to have credit to get
100%.
credit.
I remember the first exit that I had, the first company that I sold, I essentially had that company paid off anyways, but then at that point I had no debts at all. And it was about a year later, I think I said, I'm going to get a new vehicle for myself. And I went to the dealership, and, normally I would have just paid cash, but I was like, the interest rates are low. I'll just, I want a new truck. And I went in there, and I remember I met with the guy, and he called me back, I don't know, like 20 minutes later, whatever it was. And he's like, oh, we can't get you, get you financed.
You have no score.
I'm like, what do you mean you can't get me financed?
I'm all grown up. Yeah.
He goes, no, I understand. He said, you just, you need to go get some debt in order to prove a payment history.
Yes, you do.
And it absolutely floored my mind.
Yes.
And I don't remember what I did. Because I don't think I even had any credit cards at the time, or whatever it was. But anyways, so since then I've always just had 1 or 2 vehicle loans for that reason. It's not that I can't pay for the vehicle. It's just that you have to have like that monthly recurring payment.
Installment loan, yes. The regular installments. So student loans, auto loans. Yeah.
So, fun fact, if you don't
Fun
need to
fact.
take a mortgage, you probably just need to take a little car loan just to
Right.
keep out there, keep a payment history.
Right, and there's so
And then
many
put it
of
on
those.
auto pay. Put it on auto pay.
Right. There's so many of them, and they can't even get established. So I'll tell them, okay, first things first,
All
you
right,
got to
so
go to
yeah,
your
so
bank.
let's talk about that. So we'll go back to let's finish the history, then we'll
Okay.
talk about credit score.
Okay.
I'm sorry.
All
This
good.
is a rodeo sometimes. We're going around in circles. You having fun though, right?
Yes.
Okay.
So that was 21 years ago.
So that was 21 years ago you started the mortgages.
Right, right. And
And
never looked back.
And would you say that the gentleman's name was what, Pete?
Pete Thorban, yeah,
Thorban.
that recruited me into the business.
Okay, so
And-
you and Pete in the
Yep.
beginning.
Yeah, and
And
then he actually had to leave because of non-compete. You know, that happens a lot when your company is acquired.
Sure.
They have you there for a while and then they scoot you out. And
Oh,
give
so
you
when he got acquired, he
He sold
actually
it.
went to work for them.
Yeah,
Ah.
he did initially, yes.
Got it.
And so his brother was there and two other gentlemen that really kind of took me under their wing and taught me the business. And we ended up leaving in 2007 and started a company called Legacy Mortgage Group.
Okay, that was tough timing.
Very tough timing, extremely tough timing. And I had just built my house.
Oh.
So yes,
Yeah.
it was ramen noodle time.
Yeah.
And then we ended up becoming a net branch of Fairway Independent Mortgage in 2010. And so that was 15 years ago, and I've never looked back. So there's no better company, bar none, than Fairway. I am home at Fairway Home Mortgage. We just rebranded.
There you go.
Yeah.
That's interesting. So before we get on to how to establish credit, let's talk about 2008, 2009. So how did you make it through those periods? What was the game plan? What was going on? Tell me about those periods.
So,
Not to bring you back to the dark days,
right, right. But it makes us who we are today.
but exactly.
So those were very difficult times, and it was especially difficult for me because when I had been at Sallie Mae, I was their inside salesperson. I had a list of hundreds daily to call of Sallie Mae student loan people, customers, that had reached out and said they were interested in mortgage.
Really?
So I worked those phones like nobody's business.
So you literally had fresh leads every single day.
Every day. Yeah, a lot of them, you know, you're churning and
And
burning.
this was nationwide.
This was nationwide.
Wow. Okay.
Right,
So a
right.
big pool of people.
Big pool of people, but I didn't start in the mortgage industry like your typical loan officer that is just locally trying to establish relationships with realtors and so forth. I knew how to create relationships, but that wasn't my role here. And I had some through friends and family and so forth, or that you meet through naturally doing business that then want to do business with you. But my nuts and bolts were inside sales, dialing those numbers for dollars.
Got it.
And then when we moved over to Legacy, that was my concern, going with them, is saying, but I don't have established relationships, and we're only going to be licensed in Massachusetts. And I was doing a tremendous
Wow.
amount of business in other states.
Sure.
So it was, we'll teach you, we'll show you what to do, and so forth. But then the crash happened. So I did everything I could to try to go out there and build up business and establish relationships. I even did the dancing with the realtors, with Plymouth and South Shore Realtors.
Nice.
Yeah. So
What was your song?
the dances were Foxtrot and East Coast triple step swing.
Ooh, that's a
Yeah.
tough one.
Yeah, yeah. So we had, those were regional at the time to raise money for Habitat for Humanity. And then if you were one of the winners, you had to go on to the city of Boston.
And?
And
Did
I
you
did.
win?
Yeah.
Nice.
And then in the city of Boston, we had a big one at the Park Plaza Hotel.
And how'd you do?
I did not win. So, but I had fun.
That's
it
all
was
that
good.
matters.
It was a great experience. It was just like we set it up just like the show and
Yeah.
auctioned off.
I
the
knew
judges.
I knew 2007 was happening. 2007, 8 was happening in the late part of 2006 because I had just sold a couple of some lots. I think 6 lots that I had bought in Hanson, and I was building. I bought 10 and I built 4 houses and sold them, and then I kind of saw the beginnings of the whatever that fever was, whatever that was. And I took the next 6 lots and I put them on the market as builder packages, but not with me building the house, just septic approved, well in, ready for building permit. And all 6 of them were bought by, first time home builders with hard money. And I said, this is nuts. And I made literally twice the money on those lots that I did building the house and selling it on a piece of land and doing all the work.
Wow.
And I called my realtor at the time, and I was in the middle of a condominium subdivision. And I said, lower all the prices, $10,000. We need it. This is the beginning of the end. And I almost
You
made
had
it out.
foresight.
I think I got stuck with 4 or 5 units at the end, and I had to, big discount to get rid of them. But I mean, it literally went. I think, again, these are round numbers. I think I sold $15 million worth of houses in 2007, and then like $0 million in 2008. It went to like it was like a switch. It was unbelievable.
It was unbelievable. It's like someone flipped a switch. That's exactly right.
Yeah.
That's how I described it. We were running on a treadmill and someone turned the treadmill off.
Yeah, it was, and then I had also had a closing in 2007 with a gentleman for a house that I sold him, and I never used to look at someone's mortgage papers, but I happened to be sitting next to him at the closing, and I looked over and I saw his payment was $5,200 a month. And it wasn't that expensive a house. I mean, it was, $700,000, $700,000, which was a lot of money back then, but it wasn't, millions.
Right.
And after and I had gotten friendly with him, and I said to him after closing, I said, what are you doing? He goes, it was a no-doc loan. I didn't have to put any money down, and I'm never planning on making a payment.
Never planning on making a payment.
I said, what are you talking about? He says, my company moves me every 2 years. I've always wanted a new house. I don't care. I know the crash is coming. They're going to give me this money. And he never did. And you know what? He made it. He lasted 4 years there.
Before he got officially evicted.
Yeah.
Wow.
And I remember when he
malice
left,
and intent. And
yeah, all those things, yeah. And I remember leaving the office, and I was like, wow, we're in big trouble.
Yes.
And I didn't understand the scope of it because I was in my own little bubble just building houses.
Yes.
And I didn't understand all the mortgage fraud that'll go on, and people buying properties that didn't actually exist and selling mortgage things that didn't actually exist. And people multiple mortgages on the same property over and over again with different companies, and it was just unbelievable. I had no idea, but anyways, I digress.
Yeah.
So
no, we went through all of that.
Yeah. So it was tough time. So somewhere in there, you moved to what's it called now? Fairway Home Mortgage.
Right. At the time, it was Fairway Independent Mortgage.
Yeah.
Yes. And we came in at branch.
Why they did that? Fairway Independent. It doesn't seem like a good name.
Because we were a direct lender. It's our money that we lend, and it was named as the fair way of doing business.
Got it.
So there's a totem pole in lending. And so someone will say, hey, Kathleen's the best broker I know.
So when you say it was your own money, so you had investors, they had investors that were putting up the money.
Yeah.
Interesting.
And you're
getting
getting lines of credit essentially from Wells Fargo, Chase.
You were packaging those off to Fannie Mae.
That's how the entire industry works. You need to do that. You have to free up the money so you can lend it again.
Got it.
That's how it's worked. On the secondary market,
so
it's a whole
someone will go
other
get
level.
a $50 million, $100 million line of credit.
Yeah.
Go get the mortgages, get them established, and then resell them.
And then you got to get them off the line. You got to
get
sell
the money
them.
back.
Yes.
Get the money. So you're just moving that money through
you
all
have
the time.
to. Yes.
Wow.
Yeah. So the loan's not done.
I never really
for us.
thought about that. Yeah.
It's not done for us at the closing table. We then have typically less than 30 days to get that sold, or we're going to pay fines to the thousands by day if we don't have that loan sold.
Wow.
So you have to meet criteria. So that's why it's so tough with underwriting. We have to get all of these things, and then sometimes after closing, we have to go get more. Maybe they want another bank statement.
Wow.
So sometimes you have to go back. This is why underwriting is a challenge for people. Like, they kept asking for bank statements. Yes, up front. So I will tell you that in around 2011, I was very frustrated, having trouble making it work. I was doing things in the office administrative-wise just to try to make it work because I didn't have those established businesses. Values went down, rates went up, nobody's refinancing, nobody's buying, people were out of work. And I ended up, by happenstance and kismet, going to the
Kismet, that's a word I haven't heard in a while.
Yeah. So I ended up going to the Mortgage Bankers Conference, and there was a bunch of people from Fairway there that I was meeting for the first time from corporate and so forth, including the CEO of our company, Steve Jacobson. And at the end of the day, we funneled into the small little restaurant in Newport on the second floor. It was like like a finished porch is how I would describe it. And somehow we're funneling in literally like this. We get to the end and there's the wall. I'm up against the wall here. It's a bench, and I realize, oh, there's the CEO of Fairway. And I said, I'm so sorry. I don't know how I got here, but you're having a high level meeting, because I attended all the meetings. I knew there's the head of Chase, there's the head of Wells Fargo. I need to, if you could just move aside, I'll just scoot out. And he says, no. He says, I want to know who you are. Sit down. My name is Steve Jacobson. So that ended up being the most intense 2-hour interview of my life. He knew literally everything about me. We knuckled over the fact that I had been a walk-on D1 swimmer. He was a walk-on D1 basketball player in Wisconsin. Yeah. He knew that I had been taking care of my sister and my grandmother, and he knew where my business was coming from. I was very vocal in saying where I'd come from, and had been a top salesperson for AIG, and then now was doing well, but then now struggling since the crash and so forth. And because I didn't have those inside sales, I kind of always had at AIG. I was given a list: go get these producers to produce for you. At Sally Mae, here you go, get them to turn loans.
You had a warm body to reach
that.
out to.
I didn't know how to make the phone ring on my own. So he says, well, do you know who Amy Slotnick is? And I said, yeah, she's a $100 million producer. She's sitting over there. I heard her today on the platform. She was a key speaker. And he said, would you like to meet her? I said, sure. So if you know Steve Jacobson, he goes by Jake. He has a nickname for everybody. So he yells across the room, hey, Sparky, come over here. I want you to meet Kathleen Caddell. Do you know her? And she says, yes, I do. And I said, she's being kind. She has no idea who I am. I sit in this little office in Plymouth. You have no idea who I am. So he says, Amy, I've decided, we've been talking about starting a mentorship program. And I just found your first mentee, and I'm going to pay for it.
Wow, that's awesome.
My life changed like that. So Amy taught me how to make that phone ring.
Wow.
And so I ended up leaving the branch that I was with. Jake flew into town and did one of these, I'm going to make an NBA transfer, and I'm just moving a player. And so I went to work in her office, the number 1 office in the country in Newton, and never looked back.
So that's a good story. That's fantastic.
Yeah.
Yeah. It just goes to show you're only one meeting or one phone call away from everything.
That's it. You've got to get the opportunity. And
I
thank
and you have to be ready.
You have to be ready. Yeah. And I thank Jake all the time. And I said, you changed my life. He says, but you did the work. Yeah. So, but he gave me the opportunity, and he believed in me, and that is what most people need. So I take that, pay it forward to clients that come to me, and they're from a divorce situation, or they're going through the number 1 reason why I have financial crisis here in the U.S. is medical. So they've gone through some sort of a crisis.
Yeah, it's a big problem.
And they're at rock bottom. And I can say, don't worry, we got this. I'm going to show you the path. We're going to get you better. And I'm in it for the long haul. It's not that quick, instant transaction. It's that financial planner in me is still there. I come at it from a different perspective.
Yeah, it's in your DNA.
Yeah. And it's not about, here's your 30-year fixed. We have over 650 products. I can do suitability to depending upon what your need is.
All right, so that's fantastic. I love that story, by the way.
Thank you.
Let's talk about people, how you help them fix their credit, because I think that's a question for a lot of people. There's obviously a lot of people that, for whatever reason, they haven't paid attention to their credit. So how do you typically help them? What does that look like?
Sure. So there's a couple different ways. There's those that are going through a divorce, and we can talk about that, but let's just say somebody who comes to me, and I often get that Saturday night, Sunday night, 911. I wasn't even thinking about buying, and then this house came on, and my realtor says I need a pre-approval. I don't even know what that is. Can you help me? And very quickly scramble to do that. And I say, if I had only met you 30 days ago, we could get you a much better program, a much better rate. Because as my favorite expression goes, you simply don't know.
So for someone out there thinking that they may be looking for a piece of property or something to buy, and they're going to need a mortgage, it sounds like they need to start with you 30 to 60 days before they even start looking, or while they're looking.
Exactly, Buzz, because my favorite expression, you don't know what you don't know. So suddenly I pull your credit, and you might be perfect, but you don't have enough credit. You might be perfect, but you don't know that when you went to that orthodontist for your child, they never billed you properly and you have a collection that you didn't even know about. You could have
that's a big one.
It is a big
That
one.
one's a big one.
And
Now, so
lates.
just on a sidebar, so if somebody runs like Credit Karma or something like that, will that stuff show up for them if they do?
Not necessarily, and
Okay.
here's why. Because there are 3 credit bureaus. There's Equifax, TransUnion, and Experian. Each one gives you a 3-digit numerical score. The high and the low are thrown out. Whatever's in the middle is in fact your score. So when we have 2
Interesting.
borrowers, a husband and a wife, we have to use the lower of the 2 middle. So you could be getting your score just from TransUnion and think you have an 800. We can have a 100-point fluctuation between your high and your middle. So you don't really know.
Wait, say that one more time. So
Yes.
from a single borrower, they throw out the high, they throw out the low, and take the middle.
Correct.
Okay.
So you need to know all 3 to know your score.
100%, obviously. Now, if there's 2 borrowers, it can be whatever, just 2 borrowers, 2 signers of a mortgage. You said what now? You said they're going to take the
lower
lowest,
of the 2. Let's say that your score is
the lower of the 2 averages.
Yeah.
So they're
well,
going to take the high and the low in the
two
middle.
middles.
Yeah.
Yes.
So take the high and the low in the middle.
Yeah.
I'm at 720. You know, whoever's at 700, we got to go with the 700.
We have to go with the 700.
They don't combine. They don't split the difference between those.
Correct. And here's the rub: every 20 points gets you a different interest rate. So if you're
20
between
points.
a 680 to a 699, you're going to have a higher interest rate than if you got to 700, 720, 740, and once you hit 760, above that, it's really what we call gravy. So
Yeah. And what's considered like a good score? What's
anything above a 760.
okay?
Because
And
then
what's
you're
the
gonna get
highest you
best.
can have?
Well, above that, it's irrelevant as far as lending
Got it.
goes. But each of the bureaus is different on their valuation model and their score. So some of them go to 820, some of them go to 850. You know, it's different values.
Okay.
So it's never identical. So it's
It's funny. My dad's 90 years old. God bless him, and he still worries about his credit score.
Yes.
He's like, I'm at 820. I'm like, Dad, what are you gonna
which
do?
is fantastic. Yes.
I'm like, what are you gonna do? I said, you know what? We should take out a huge mortgage. You can beat him.
Well, when you do that, your score is going to go down initially, but it's going to go up because you have to have credit to get credit. Yes.
I joke about that with him all the time. We were just having that joke the other night. So, anyways, all right. So now we've found our credit score, but we have to use a real credit score person to help
Correct.
us.
A lender.
Now,
Yes.
the old days, you never wanted to pull your credit because it dinged your credit.
Yeah, misconception.
Okay, so that's not
an
true
old
anymore.
Wives' tale. Yes.
It used to be true, though, right?
Well, it's true to the
Kinda,
sense
sorta,
that
true.
it's true to the sense that if you are applying for a mortgage and at the same time applying for an auto loan and a student loan and a credit card, the credit bureaus are not human beings. They're binary code that's now saying, oh, Buzz, it looks like you're looking for money from any and all available sources. So you're going to get dropped drastically. So during the process, when you're about to go do a mortgage, you want to make sure that you've had no lates. You do not want to open any new credit because the moment you apply for new credit, your score drops 15 points and it takes 6 months to get that back.
Really?
So resist the urge when you're at
So
TJ Maxx.
every loan that you take, your credit score drops 15 points.
Initially. Because the credit bureau is then saying, you're going to get new debt. How are you going to handle that? Yeah.
I'd love to run my score and see what it says. It'd be interesting.
Well, you can go to www.annualcreditreport.com and find out because you can get a free report from all 3 bureaus there. And that's the only one that's actually free. Not freecreditreport.com.
Wait, so we're going to put that on the screen. What was that?
And I emphasize this because if you just put in this for Google, you're going to get rerouted. So www.annualcreditreport.com. I encourage everybody.
And that literally you can run it once a year?
Yes, but once a year from all 3 bureaus. So I encourage everybody, maybe January you pull from Experian, maybe in May you pull from Equifax, maybe in September you pull from TransUnion, because not all of your creditors are reporting to all 3. So you could have pulled Experian and think you're fine, but then Kohl's is reporting you to TransUnion.
So it doesn't aggregate. It doesn't aggregate all 3 when you do that annual credit report.
And very few of them report to all 3. A lender typically will.
You think there would, at some point, there'd be some consolidation in that industry?
No, Buzz, there's no logic in credit. So I will tell you.
Maybe that's the new frontier. Maybe that's the new frontier.
And
we're going to take over with some AI bot.
Exactly. So I'll give a couple of free tips. One is 30% of your score comes from your utilization of credit. So let's just use nice round numbers as an example. Let's pretend you have a credit card that has a $10,000 limit. You want to keep that balance at 30%, so $3,000 or less. The moment you go above it, you lose points. You keep it below it, you gain points.
Wait. Say that one more time. So we have a $10,000 credit card.
You want to keep it at 30% utilization.
So does that mean I only charge $200 a month on it, even if I pay it off right away?
$2,999. Yes.
Oh, right.
Yes.
Gee,
Or a trick of the trade would be
no, it's
you go
32.
make your,
It's 3,300 of 10,000 is 1/3. You said 30%, right?
30%. So if you
don't trip me up on the math.
If you are
wait, but
making
what if I pay off the credit card every month? Does it matter?
Well, what's being reported is the balance at the time that your credit statement is happening.
So
they each
even if you're
report
paying on time,
differently.
it doesn't matter.
Right, because at any time I'm going to pull your credit, it's a snapshot in time. It's like taking your body temperature.
So if you have a $100,000 credit card and you just jacked up to 80,000 because you had a big month or whatever, and then that's the moment they run your credit, it's going to say you're using 80% of that credit.
I see a debt of 80,000, and here's how it impacts you for a mortgage. Number one, your score just went down.
Right.
Okay. But number two, that affected what's the most important criteria when you're applying for a mortgage is something called your debt to income ratio.
Sure.
And that's when we look at the gross amount of money that you make every month and divide it by your minimum obligations.
I got to run my report. I want to.
Now you're dying to see.
I am.
Yeah. So
we might have a follow-up episode where you go through
just
that.
on credit. I could talk just on credit.
No,
for 2 hours.
I like that idea. Actually,
Yeah.
we're gonna figure out a way to do that and go through and dissect that and say this is why that affected you for that.
Yes.
I mean,
so sometimes I meet you and I'm saying, okay, I need you to do A, B, and C, and then I can get your score up 15 points, which puts you into a better loan
and
program.
what's the time? How long does
better
that
rate.
take from that ABC?
Well, assuming you have the cash to make the payment, or sometimes it's just literally transferring from one credit card to another to levelize those utilizations. And then it takes me probably, after I get proof, about 10 days for the bureaus to update. So then I can do a credit refresh.
So it's pretty quick.
It's pretty quick, but I don't
So you're
necessarily have the
coaching.
time.
Yeah, so you're coaching. So again, that's why how we started this conversation. So if I'm thinking about a mortgage and I need a pre-approval, the sooner I engage with you, then you break all this down for me and say, okay, you need to pay this credit card down by $5,000, excuse me, or you need to do this, or you need to do that. That's going to fix your score in approximately 2 to 3 weeks.
Mm-hmm. Mm-hmm. Yes.
Wow.
But then you need to put that card in the freezer for a minute, because I can't have you change that, because I want to keep your score as
Right.
it is for a moment.
Yeah, so
Yes.
at that moment in time,
Mhm.
you say, okay, don't just make all your payments, but don't do any other purchases.
Or if you need to, I say you just do life like you normally do. You're going to use one for gas and use one for groceries. Just go home and pay the bill, because we're kind of all cashless now.
Yeah, don't
So
let the payment, don't let
it hit
the
to the
balance
bureaus.
build up.
Yes. So here's the shocker: don't close a card. That's probably the number one mistake.
Don't close the card.
Don't close any card, ever, if you can avoid it, ever. Because 35% of your score comes from your credit history. So now that you've just closed the card.
35%.
Yes.
And so once you close the card, there's no more history.
You've lost that. Not only that, you've destroyed your ratio, because now you have less available credit overall, too. Double hit. So I have people come to my first-time home buyer classes and go, Kathleen, I just did the greatest thing. I just paid off all my debt. I say, that's fantastic. Yes, and I closed them all out. I say, that's horrible. Call them all back up and see if you can reestablish, because we need that credit history. Now you just made yourself a problem.
So the best thing then, if you are on that journey, is to pay them all down to zero or close to zero, and then keep them open as long as there's not a huge annual fee, which most credit cards don't have.
Yes, but here's the thing. I want you to focus on the one with the highest minimum payment, rather than, we don't care about the volume of debt that you have. We care about what's coming in every month and what's going out, because that affects your debt to income ratio.
Wow.
So
this is part alchemy, part voodoo science, part it's not brainiacs part spreadsheet,
Financial planning, yes.
financial planning.
Yes, all of that. There's
Is there
more
any
to it.
like sacrifices involved with chickens or anything to get this thing done? Or?
You might need to do that with the realtor to get your offer accepted. That's a whole other story.
So again, it goes back to having someone that really understands what they're doing.
Yes.
And when they say to do something, you just need to do it.
Yes. Having a coach. You need a coach in life.
100%.
Yeah.
100%.
Yeah.
That is, and that is difficult for a lot of people, including myself. So I can understand that. So.
And people don't know where to begin the conversation.
Yeah,
they just start
100%.
calling us saying, "What's your rate?" Which I have to laugh and say, "Well, what's your story?"
Yeah. How long is a piece of string, right?
Yeah. Yeah. Oh, is it a primary residence? Is it an investment? Are
Sure.
we doing new construction? Are we doing a renovation? Is it just your pure vanilla 30-year fix that you're looking for? So it matters. It matters on the property type, your credit score, your debt to income ratio.
So let's talk about what it looks like to work with Kathleen, senior mortgage consultant at Fairway Home Mortgage. So best way to get in touch with you is phone call, email. What am I
Cell
doing?
phone's best. I always have it with me.
All right. So hello.
Hello.
And then what happens from there?
So I want to hear your story. I want to hear, and I'm taking copious notes. Most importantly, where I begin.
So this is a high touch, white
Yes.
glove, customized experience for every single customer.
Yes, everybody's getting red carpet treatment from me, 100%. Regardless of your circumstances, absolutely.
Right. So most important thing people don't understand is the reason you're calling them is you're actually going to pay attention and talk through. You're not going to try to jam some boilerplate thing onto them because you're getting a deal this month or whatever that is. You're going to hear that story first and then develop a plan.
Right, and more importantly, I want to find out what their personal budget is, because there can be a huge difference over what you're qualified for versus what you're comfortable with, and my goal is to keep you comfortable. I don't want you in that house rich and cash poor and never able to take a vacation again. So it's important, instead of going, well, I want a house for $650. Okay, take it down for 1 second. Let's forget that. I want to know what you want your payment to be, besides zero, realistically, and what you want for total out-of-pocket cash, because then I can design it. Then now I'm going to ask you, okay, what town do you want to live in? Because each town has different costs associated. And what type of property? Are we talking a condo? Because then we're talking HOA dues. You know, are we talking single family?
Hidden fees. That's a big one, right?
Yes. So it's really it's comprehensive. So then I'm going to make you give me your blood, urine, EKG, and negative COVID-19 twice. And I'm going to scrub it. I want to pull credit, scrub it, go through everything,
So
and make
at
sure
that point,
you're
we're
solid.
transitioning to some online portal where I'm sending everything.
I'm taking your application live and in person. We do have an online app, but I
Sure.
prefer to do it live
Yeah.
because then I
So
can ask all those follow-up
Your dream
questions.
is that they call. The best way is to call you personally, have that conversation.
Correct.
And that lasts anywhere from 5 to an hour?
15 minutes maybe
15?
initially, and then I'm sending you a link and I'm having you upload securely
Okay.
directly into your loan. I'm going through it all, scrubbing it. If I'm missing something, I'm letting you know. Follow-up questions. Sometimes it's comprehensive. You could be self-employed. It could be a lot of differentials. Maybe you're a cop and or a nurse and having all these different differentials in your pay stub, and I need to.
What's a differential?
So night shift.
Oh, okay. So different sources of income.
Yes. Maybe like a nurse, she works in the ICU. She gets more
She
out
gets a
per hour
benefit
in
for
that
this.
one. And
Right.
So it's not always cut and dry. My salary is $60,000. Great. That's
100%.
easy, but that's very far and few between. Most everybody
Yeah.
has a bonus structure, commission structure, or something. So we need to nail down what that income is, both from a compliance standpoint as well as from a qualification standpoint, because maybe you're a first-time home buyer and I'm going to put you into one of the 100% financing with down payment assistance programs, and there are income limitations on those programs. So I need to nail that down. Then I'm scheduling that call with you and your co-borrower, if there is a co-borrower, and I'm walking you through everything. What your potential payment's going to look like, your cash to close. I'm giving you that sticker shock. 2 sticker shocks, payment and cash to close. And then I'm walking you through every potential penny of cost and explaining the entire process to you. So that takes about an hour, and that's what I call my shortened version of a first-time home buyer class.
Wow. Okay.
So making you qualified and
So
confident.
how young can you be to get a mortgage?
18.
Okay, you can get a mortgage at 18. Is there any age limit?
Never.
That's fantastic.
Never.
I love that.
And I have an awesome program for those that are over 62 years of age. They can have a payment-free mortgage.
All right, we're going to talk about that.
Yeah.
So we've done the intake call. So at some point, do I get handed off from yourself to a back office person that's helping me?
No, I'm going to hand you to a realtor. If you have one, a lot of times people refer to me by their realtors.
Sure.
Or I'm going to find out where you're buying and then try to match you up with one of my trusted
Oh, so
realtors.
you'll actually get calls before they even have a realtor.
A lot of times, yes.
Interesting.
Which I prefer, quite frankly, because then it's not a 911 situation. It's often a 911 Sunday night. They walked into an open house, and now I'm trying to do square peg, round hole, yeah, and fit them in there.
Right, and anytime you're rushing, there's always compromise, and it ends up costing more.
Exactly right.
All right, that's interesting. So let's talk about my favorite subject, which is accessory dwelling units.
Yes.
So tell me what you know about that and what you've seen for financing options, and then we're going to pivot to your 62-year-old loan program.
Yes, which is perfect for this product.
And it is.
Yes. So you can now, because of the governor of Massachusetts has made a law that you can add an ADU to your home. It can't be higher than 900 square feet or 50% of your GLA.
Well, it's funny you should say that. So there are now 5 towns that I know of that you can exceed the 900 square.
Really? Do tell.
Yeah, so Plimpton is one.
Okay.
So these are all in the works. They haven't been approved by the Attorney General's office, but I don't see why they wouldn't.
So these are proposals.
Well, they were passed at town meeting
Okay.
and voted on,
That's a big step.
right? But most people don't understand it. Just because something passed town meeting, it isn't law until the
Correct.
Attorney General signs off on it.
Correct.
So the town of Norwell passed a accessory unit bylaw of their own, and they didn't make it more restrictive. A couple little things, but I didn't see anything bad in it. I only read the draft. I didn't see the final document. But it does say in there that with planning board, so you can do as of right up to the 900 square feet or 50% of the gross floor area of the primary home. Don't make sure you say gross floor area because it's a different definition. Or if you want to go to planning board for a special permit, you can go up to 1,300 square feet.
That's good.
It is.
That's very good.
So I have a client that wants to build an ADU in Norwell.
Okay.
We don't want to go that big, but we really need about another 100 square feet to make the floor plan they want. So I'm excited. I called the planning board and they said that the Attorney General's office asked for a 60-day extension to approve or modify. So we won't have a final answer until I think she said October 10th. So that'll be an interesting one. I'm excited about that because there are many times that I wish I had another even 50 or 60 square feet.
Make a big difference.
To make the floor plan that I want to make. All right, so let's talk about financing ADUs. Have you done any of these deals yet?
Yes.
What does that look like? So obviously no names in dollar amounts, but give me the general gist of the scenario and then what you ended up doing for financing.
Sure. So there's a couple of different options essentially. First thing we could do is a cash out refinance on their home. A lot of people don't want to touch their 2 and 3% rate that I put them into 5 years ago. So they're concerned about that. So if there's enough equity in the home as is right now, we might be able to do a second mortgage. So we have a lot of closed-end second, which means it's a 30-year fixed. It's not a home equity line of credit. We can do those as well. But it depends upon the need and how long and how quickly do you want the money and for how long do you plan on keeping the mortgage. It's all about suitability there as well.
Sure.
So that's option one. Option two, which is oftentimes what people are doing, is a pure renovation loan. So we can do that at purchase, or we can do it for a refinance. So we take the bid from you, and we take the purchase and sales, assuming it's a purchase, and we give that to the appraiser. Now the appraiser is going to do the value as if the work was already 100% complete. So we can lend up to 97% of the future.
Wow, 97%.
Yes, of the future appraised value.
All right, let me break that down for people listening. So I'm just going to use scenarios. So daughter A is here, mom B is over here. Mom wants to build an ADU, but daughter A's property doesn't support it. So they go out and find a piece of property to buy, property C. And A is going to buy the property, the daughter, and B is going to build the ADU. You're saying we can put that deal together, and I'm going to use round numbers. They're buying the house for $600,000. My contract is $400,000 to do everything. That's $1 million. We're going to get that to the appraiser, and assuming he agrees with those numbers, we can get a $970,000 loan.
Maybe. So maybe, because we have county loan limits.
Okay.
And so, yes, for
So
conforming or jumbo.
We're going to hit some ceilings
There
there
are
at some
some,
point.
yes. But in that case.
What is, like, what's Plymouth County loan? ceiling?
860
860.
for conforming, yes.
Okay.
But
So-
then we have something called the high balance loan limit.
But wait, there's more.
But wait, there's more. So yes, we have another whole subcategory because no surprise to you, Buzz, we're one of the 3 most expensive parts
Sure.
of the country
Right.
for housing. So yes, we do have other options. So that's in the 900s. Yeah,
Okay. So there's a lot of ways to get an ADU financed.
correct.
But I'm going to give you a little twist right now. Are you ready?
Yes,
All right.
lay it on me.
And I haven't proven this yet, but do you know Bob Galvin? Have you ever heard that name, the attorney?
No.
How about Bill Sims?
Yes, I've heard that name.
Okay.
Yes.
So he and I just had a podcast together
Yes.
here. I think he was 2 people ago. But I believe there's most towns, I don't see anything in the state law or any local town bylaws that keeps me from condominiumizing the house and the ADU. My question for you is, I can't do that if I have a current mortgage on the property, correct?
That is correct.
So-
Same as if you had a multifamily in Boston, you suddenly want to condoize it.
So you have to pay it off to do it?
You have to have permission of the lender to be able to do
All
it.
right, so essentially pay it off.
Yeah.
So let's talk about that. So let's talk about that $1 million scenario, ABC, right? So ABC, we build C, it's done. They owe $600,000. They had, mom had a bunch of equity, so now they're back to $600,000 for what they paid for the house once she sold their property and paid it down. What would we need to do if they still have that $600,000 mortgage to condominiumize that property?
Well, we're gonna be condominiumizing. I can't even say that. Thank you. But we're going to.
We're going to condo it.
Thank you. We're going to condoize it, and we're going to have 2 different owners in that scenario.
100%.
Okay, so we need to do a sale. It's a purchase and sales agreement that needs to be done, and then that mortgage is going to get paid off, and they would have to refinance it because they now don't have a mortgage on.
Sure. Yeah. No, I was just.
Yeah.
I've been mulling that scenario over my head, and I couldn't come up with a reason why you couldn't do it, legally with
Yes.
the current EDU bylaw. But I wasn't thinking until you said it, and it dawned on me, that hey, we have a mortgage company we need to deal with.
Well, right, because now you have a property that was
100%,
worth
we can't
600,
transfer it.
and now it's only worth 300 because
Well,
you're talking about half of the area.
maybe it's still worth 600 and 400 though.
Right.
Right. Depending on how it's broken up. So
Right.
in your scenario, then we have to sell it to our
Daughter.
condominiumize it.
Yeah.
So condo A and condo B has to sell to each other and then pay off the first note with the lender
Right.
from that sale. Okay, so it's doable.
That's
And
for-
depending if you're in a falling interest environment, you might actually lower your payment.
Exactly. Yeah. Right.
Okay,
Which,
so
pray
anybody
God, we're
listening,
going into.
anybody listening, I really, really want to find someone to do it
Yeah.
with.
Try it out.
Yeah,
Okay. Sounds like
So-
a good plan.
I'm putting that on you.
Okay. All right. We'll see.
The pressure's on
I got to
you.
get them pre-approved first. Yeah, so.
The pressure's on you first. So you said you had, what, 600 different loan packages?
Yeah.
Wow. How do you keep all that straight?
Well, it works out that way because you have 30-year fixed and 20-year fixed and 25 and 15 and adjustable rate mortgages and so forth. So it's just really all about suitability and what
Got
am
it.
I doing? Am I doing a reno? Am I doing a cash out refinance? Are we doing a purchase? What's the type of property? Is it primary, secondary,
So
or vacation
you're running
home?
a lot of what-if scenarios
Oh, yeah.
with the customers.
Yeah. And is it going to be an
So
investment
again, this
for
is
them?
why they need to call you
Correct.
and tell you the whole story of what
Correct.
they're trying to do. Don't leave out any little tidbits
Well-
that they might be embarrassed by. This is kind of going to confession, if you will.
I'm your first line of defense. I need
Right.
to know the whole story so I can advise you properly.
Right.
You can't just call your doctor and say, hey, send me a script, because I went to WebMD and I know this is what's wrong with me. So just send me that script. I'm good to go.
I had to stop looking at that website
Yeah.
because I was all the time. I was like, oh,
You're dead and buried every time.
Yeah. I'm like, oh, I have that.
Oh,
I
yeah.
have this.
You're dead.
And then I'm like, you know what? Just take a vitamin. You'll be fine.
So, Buzz, these are the words I literally use all the time. Like, Google is not your friend when it comes to medical or finances. You're dead and broke every time. So.
Well, you know what? I think those are wise words.
Yeah.
Maybe that's a Kathleenism.
Yeah, here we go. We're starting something here.
Yeah. Kind of book. All right. So
the 62.
Oh yeah, so let's talk about the 62-year-old product.
A retirement payment-free mortgage.
So it's different than a reverse mortgage.
We have rebranded it. It is now called a HECM, and I sound like I'm clearing my throat or saying a nice Yiddish name, but
what the HECM?
What the heck is it? It's a home equity conversion mortgage. We do love our acronyms in the mortgage world. HECM. Yeah. So what
I'm kind of jealous. You do have a lot of good acronyms.
We do, yeah. It's kind of like a club.
I'm going to think up my own.
My favorite is CTC. You're clear to close. So
I like that one.
Yeah, you do like that because that means you're getting a paycheck.
Yeah.
Yes. So for the home equity conversion mortgage, the two criteria that you need to be 62 years of age and older, and you need equity in your home. What we can do is tap into that equity, and you can use that money for whatever purpose that you want. The older you are, the more you can tap into, obviously. It is a negative amortization loan. So it's different than, say, the mortgage I have on my house, where I start off with a big balance and I'm paying a little bit of principal and interest, and it's going down. This is going the other way. So we start off small, interest is accruing, but payments are not required. Payments are optional. You can make a payment, but they're not required.
Interesting.
This must be on your primary residence.
Yeah.
There are rules. You need to maintain the property.
Minor point.
You would anyway. You're not going to let the lawn go up to 5 feet, and you're going to not let the roof leak on you.
Theoretically.
True. You are going to continue to pay your real estate taxes and your homeowners insurance. Okay? And you cannot vacate the property for more than 12 months and a day. And the reason we have that rule from the government, yes, the government put that rule in because maybe you are a senior that goes from the hospital to rehab and you're boomeranging. Right. Or more often here in Massachusetts is that we have our snowbirds. So I've had clients that took a HECM on their primary residence here in Massachusetts, took the cash and bought a condo in Florida. And they have no mortgage payment on either property. And they're snowbirds. They're coming back and forth. But this needs to remain
what happens, though, the day of reckoning?
So there's a lot of misconceptions about this product. I would say it's the most misunderstood financial tool.
I can truthfully say I've heard this 4 times now, and I truthfully can say to myself, at some point I feel like the sledgehammer is coming down on me.
Sure. So number one misconception, I no longer own the property. You absolutely do. Sure. It's a lien like any other lien.
You and the bank, enjoy it.
Yeah. So I own my property. It's my name only on the deed, and it is my mortgage, but I still own it. Second thing is, and this is what a lot of people say, is you're screwing the kids. You're taking away their inheritance. And I'm saying if you set this up properly, you could potentially leave more money to the children. And the reason is this, because this product changed drastically in 2015. 21 years ago, I put people into this loan to save them from foreclosure. Now, it's completely opposite. I feel the obligation to tell every 62-year-old about this because it has changed so drastically. Even multi-millionaires are being encouraged to go take this out the moment they're eligible from their financial planners.
Let's explain. Let's use myself. So I'm 64. Mm-hmm. So I have a house. Again, we're just going to use round numbers. It's worth $1 million. So you tell me to do what?
If you have a mortgage now,
let's pretend I don't have a mortgage.
Okay. So then I would have you set it up, not necessarily take any cash from it, because there's 3 ways you could take cash from it if you were to get this. Number 1, you could take a lump sum. Number 2, you could get what's called a tenure. It's kind of like an annuity where you say, I need an extra $1,000 a month, Kathleen, because I can't keep, Social Security's just not cutting it.
Understood, yeah.
And then the third
That one I understand, and
Yes.
I love it that that's available to people.
Yes.
Because
And
they're not really spending the money fast, but
Right.
they're at least maintaining.
Right. And then the third option is that you could do nothing and just have a line of credit. And there is the game changer. This now comes with a line of credit that actually grows at the interest rate plus a 0.5 point. So now the interest rate is working for you. So a completely different mindset than when you're coming for a traditional
All right, so
mortgage.
let's use my house. So
Yeah.
it's $1 million, and you're saying I can, like, how much of a HECM can I get?
Well, if you're young, in your early 60s, then you're going to get probably 40% access to it. If you're in your 80s, you're getting 60 to 70% access. I have a client that's 100. She's almost getting complete access. No joke.
God bless you.
Do you know why? Because her 80-year-old daughter can no longer lift her out of her wheelchair and take care of her.
You know what?
So.
I mean, I think it's awesome that you have that ability to do that.
Yes.
I mean,
Yes.
it's phenomenal.
It is. We don't care about income.
Yeah, no, it's
We
phenomenal.
don't care about credit. We just care about equity. And we do need to get your blood urine.
So my scenario, I can get a line of credit for $400,000.
Potentially.
That's what you're
Yes.
saying.
Yes.
But you're saying if I don't use it,
It's sitting there and growing.
So
right
when
now
I'm
at about 7% interest rate,
Okay,
growth rate.
so 10 years from now, I would have.
Well over 1.5 million that you can pull from at any point. You can call and request that money and have it within 5 days. Suddenly your roof's leaking, you've got the money. Suddenly you have a medical change and need someone like yourself to come in and make
and
amendments
there's no
to
yearly
the house.
fee to have that money tied up?
Yes, there is. Because the U.S. government is going to take their fees. Okay, this is done by HUD and this is an FHA loan, Federal Housing Administration, so they thoroughly insure it. So this is the next misconception. Kathleen, those are too expensive. And I say,
Wait, but just hang on before, and I want to, believe me, I want to really break this down because it's important for people. But again, I'm just going to pick on myself. So now I have access to $400,000, and I don't borrow any of the money. I just say, you know what, I'm going to save it for a rainy day. What does that cost me per year to keep that?
on the drawn amount, so whatever you took out, maybe you just financed the closing costs, you're going to have 0.5% as mortgage insurance premium that's mandatory.
No, let's pretend I paid the closing costs.
Then you have nothing, no fee.
So I have a $400,000 line of credit that costs me nothing per year.
Right.
There's no hidden fees, there's no yearly membership,
No,
nothing.
and that's sitting there growing.
And I can pay that off anytime I want.
Correct.
No prepayment penalty.
Right. You can stay in that house and make no payments regardless of what happens to values, regardless of what happens to you for your income for the rest of your life until you're 150. And if you live longer, we will extend.
If I make it to 150,
We'll have a birthday party and then we're going to extend it.
we're going to have more than a birthday party. Damn, we're going to blow that 400
Right?
grand.
Yeah, heck yeah. But see, that's the key, is that it's your
I'm putting that in my calendar.
goals. Everybody's
Actually,
going to have a goal.
wait, it'll be worth more than 400,000 by
Oh,
then.
heck yeah. Yeah.
That'll be
and
like
your line
$5
of credit
million
is
bucks.
just tremendous at that point.
Yeah.
Can you imagine? You're having one heck of a party.
We're going to have a $10 million send-off.
Right. So why financial planners are telling their very wealthy clients that don't need this is to say, okay, instead of tapping into your wealth that is with the financial planner and invested, let's let that sit there and
Leave
grow.
it alone.
And
Yep.
you can tap into the line of credit for when you need it. So you could do something called a coordinated strategy. So maybe in an off year for the stock market, you're pulling money from that line of credit to make your expenses. And then in a year where it behooves you to take out, you are leaving that line of credit and you're pulling out of your bucket with the financial planner.
Or paying this down.
Right. This way the assets last longer, because the average person, they're spending that all down to nothing, and the only thing they have left is the equity in their home, and then I'm getting the phone call and saying there's nothing left.
I know we're getting way into the weeds here, but that's a good scenario for someone, like you said, let's pretend they have, $2 or $3 million worth of 401k or whatever that is, and they're living off a portion of that to supplement their income or, Social Security or whatever it is. And all of a sudden the stock market has a downturn and they're like, gee, we're not getting those annuity checks or whatever it is. Again, I'm spitballing here, but and now I say, gee, I'm short $3,000 a month. I don't want to dip into my emergency cash savings, so I'll go over here to my HECM and I'll take my $3,000 a month for the next 12 months. I borrowed $36,000. I didn't make any payments on the $36,000. And then the stock market jumps back up. I made an extra 250 grand over here. I'm going to take 36 plus whatever interest is accrued.
You are spot on. You are getting it.
Pay that down.
Now you ready for me to blow your mind?
I am. My mind's pretty blown already, but go ahead.
Now let's say your CPA.
I might need to put seatbelts in the seats.
So let's say December rolls around and your CPA says, I want to talk because you're self-employed, what your income was, what your expenses were. We're going to need we're going to need a write-off for you. I want you to take $30,000 and make a payment on that HECM in December, because in January you're going to get a 1098 to write off that interest. And guess what you can also do? Pull it back out.
Wow.
Goes right into that line of credit that's going to sit there and grow. But you can use that money for whatever you want. So I've had people buy another property with it. I have a couple in Chelmsford, my favorite story. They're using that as the fun. They are tandem biking the world right now and living off of the equity in their home to do so, and leaving all their nest egg, which is sizable, with their financial planner to let it grow, because they're very young and they're probably going to last at least another 30 years. They're young and healthy. In addition, you could take that money and pay for in-home care.
This is good stuff right here. I don't know how we got down this track, but I love it.
It's fun. And
I told you we'd have fun.
Yes. You can also give the inheritance to your children with a warm hand rather than a cold one. So you're sitting back saying, okay, everything's tied up. I've got trusts and I've got financial planning and all that, but my kids are struggling. I'd like to pay for my daughter's wedding. I'd like to help my son with his new job, and I'd like to give my other daughter a down payment towards her house. Pull it out of the line of credit, no payment, and give it to her now.
Good point. So when you expire at some point, the house gets disposed of, it gets paid from that, and then there's no estate tax on it either.
I'm not going to give CPA advice, but yeah. So
yeah, no, I mean, it makes sense. It's just a debt like any other debt.
Right, but here's also the protection for the senior. So the U.S. government, so I was talking about the expense, where people say, Kathleen, those are too expensive, and I say, they are too good to be free, is what they are. So the U.S. government says, okay, you Buzz, give me 2%, not Fairway, not Kathleen, you give me the U.S. government 2% of whatever the appraised value is today, and I guarantee you that you will never have to make a payment, no matter what happens to values, no matter what happens to you, as long as you maintain it, live in it, pay your taxes and insurance until you're 150. In addition, we cannot turn off that line of credit, ever.
Really?
What happened in 2007?
Yeah, a lot of lines of credit, including a couple of mine, got pulled.
That's right.
That's why, shout out to Mid-Cape Home Center, that's why I don't buy from you anymore, because you cut my line of credit.
It can never happen here. That's insured. It's worth that 2% of today's equity to give to the U.S. government for that.
So back to my scenario, it's $1 million. Let's pretend I borrowed $1 million. Let's pretend I borrow $1 million. So I'm going to pay $20,000 one-time fee for that privilege, and I'm locked in forever.
Correct.
Wow.
It's called a non-forfeiture benefit, and that passes to your heirs as well. Because here's when the kids are saying...
So this is quite a product.
It is, and this is why it's the most misunderstood financial tool.
So who's backing this thing?
Fairway Independent Mortgage. We're leading the country. We're doing #1 for purchases in this. We can do them in 13 days from offer to close.
Really? So this is a product that someone can use to build an ADU as well then?
Correct.
Right? So daughter A, her property will support an ADU. She's got her mortgage almost paid off or close to it, or vice versa, whatever that scenario is. They do the HECM, they build the ADU, mom sells her property, takes out, because they don't want to live together till it's done. She clears $600,000. She takes the $400,000 and pays down the HECM.
It has to be done on their primary residence, and everybody who is on title needs to be on the loan. So everyone would have to be 62.
Right. Oh, okay. Right. The daughter would have to be 62.
So there's some rules on that.
Okay.
Yes, but
let's pretend mom builds the ADU
on her house.
On her house, then that'll all work.
Correct.
And then the daughter can live in the primary house, and the mom could live in
Correct.
the ADU.
Now let's
they can't differentiate between which house you're living in.
Right. Now let's fast forward. Mom passes away. So you have 6 months to pay that loan off. But if you're making good effort, they'll extend it, okay? So you have choices as the heirs. You as the homeowner can leave it to whomever you desire. Charity, you can leave it to your kids. The heirs have a choice. They can either pay off the lien if they have the means to do so. They can refinance it, and we give them a little discount, 95 cents on the dollar. Or, probably what most people do, is they sell the property and the lien gets paid off and they walk away with the net proceeds. It is never ever designed to be upside down, which means you owe more than what the house is worth. But what if? What if we had that 150-year-old birthday party, okay, and it's gone, and you took all the money and you went to Vegas? Good for you. The kids turn in the keys and walk away. They never have to repay that
Right,
debt.
because they're not on the hook.
Right? And here's all the money with the financial planner being
Yeah,
left
got
to the
left-
kid.
yeah.
And this is how you leave more money to your kids than you would have otherwise.
That's a great product.
It's phenomenal. It's the most misunderstood product and misjudged.
So we're going to have to do a separate follow-up issue on that because we're going to really play some what-ifs on that. That's like a separate podcast.
It's
for
a
that.
game changer, this product. It is a complete
Yeah.
game changer, and I truly feel the
So
obligation.
I need you to bring a financial planner with us.
Okay,
And we need to have a three-way
perfect.
and talk about that whole scenario. Cause
You got it.
That's a good episode. I want to understand it for myself, to be honest with you.
I have one I just closed doing this scenario, and that financial planner took a while to understand it. He still had that concept of, well, I'm going to give you her because she's a widow and her son died, so we're not screwing the kids. I'm like, you should have sent her to me 5 years ago. She would have more money than now, you know. So and then you could have as the financial.
Yeah, we need to do a separate episode on that.
And the financial planner makes more money because it's sitting there growing. Don't wait until all the money's gone.
Yeah. So the moral of this story is you call up Kathleen, you tell her your story, and then you're going to work through all the scenarios to find the best one.
That's right. So calling me and saying, "What's your rate?" Not the way to begin.
Yeah, it's the
but
same.
then nobody
it's
knows
the same
that.
thing. I mean,
yeah,
but it's what we're conditioned to do. The first
Correct.
thing people say to me is, "How much is an ADU?"
Right.
Like, okay, well, we have a few things to discuss.
Exactly.
About 100.
Right.
But let's
Yeah.
start there.
Yeah.
So of course we say
Exactly.
they're about this much,
Correct.
right? And then we get into the scenarios.
How are rates? They're fantastic.
How long is a piece of string? No, so that's the question. So let's talk about that. So I call a mortgage company like yourself. What is the first question I should be asking?
I want to get pre-approved. I don't know where to begin. How do I begin? And I say, let's take a deep breath. Let's just talk about you. What do you want? What's your goal? What's your dream? What do you want the payment to be? What do you want? What do you have available for cash? Where do you want to live? And then let me design a plan, and then it's going to be a fluid situation. I'm going to come back and say, here's where you're at. There's what you could do to get more, or you're completely thinking in the wrong space. You could actually be buying $200,000 higher than what you were thinking.
Right.
So, but what I want is people to start with me, because if they're looking at $1 million property, but they're only approved for $650,000, nothing looks good after you've been shopping $1 million properties.
Yeah.
So.
Yeah. So again, to recap that, call Kathleen first and say, what is the lead in?
How do I begin?
Right. All right. What have we not talked about? Because then we're going into lightning round.
Okay, lightning round. I'm also a certified divorce lending professional, so I can help people navigate the divorce process and make sure you talk to me before you sign your settlement agreement. And especially for our seniors, we have a lot of silver divorces happening. Those
Really?
a tremendous amount. It's an epidemic, and
What's the term called?
silver divorce.
Silver divorce.
So they've now retired and said, I don't want to retire with you.
Wow.
So when that divorce happens, we can do a HECM to buy out the spouse. We can do a variety of different things. Maybe now we need to do an ADU on the daughter's house. There's so many options, but a lot of times people go to their divorce attorney who is advising them the best of their ability, but they don't necessarily understand mortgages, and what they agree to may not necessarily work. So you then come to me and you have a 60-day court order to go refinance the property and buy out your spouse, and then you get the reality check.
Yeah, it's not enough time.
Either you're not qualified or you're going to throw up. when you
Yeah.
see what that new payment's going to be.
Right.
So it's better to
So-
know your options.
Right. So again, hi Kathleen.
Here's my story. How
Right.
can you help? And then I say,
So
how
again,
can I
but
help?
it goes back to tell you the whole story.
Yes.
The reason why I want to get money is to do this.
Yes.
I'm getting a divorce. I want to buy a new house. I want to build an ADU.
Yes.
I want to help my
I
mom.
want to pay off my credit cards.
Someone's in problems. Someone has health problems. How can I help them? Yada, yada, yada.
Exactly.
Right. So you're part therapist, part mortgage broker.
I should have minored in it in psychology. Anyone in real estate will tell you that. All the realtors. and
Yeah, no,
lenders.
it's that's one thing that I learned about the ADU world is that 70% of an ADU transaction is about the family dynamics, and 30% of is actually what we're
It's very
building.
emotional. Real
It is
estate
because
is very
especially if there's multiple siblings.
Correct.
Right, which sibling is doesn't sound nice, but which sibling is mom going to?
Right.
Right, or mom and dad, hopefully. Or actually, I didn't even think of that. So silver divorce. Maybe there's 4 kids. Maybe mom's going here and dad's going there.
4 parents too. They both get remarried. Yeah.
This could be like a reality show.
Yes, it can be.
Wow.
You may have tapped into something here, Buzz. We're going to start one.
AD reality show. I think I'm going to skip that.
Yeah.
All right, lightning round.
Okay.
So first of all, great episode.
Thank you.
I had a lot
Thank you
of
for
fun, and
having me.
we're definitely doing that follow up.
Okay.
With that whole silver
Silver
HECM
divorce, yeah.
and a financial planner. So
Love
think
it.
about who you want to invite to that.
Love it.
So favorite tool you can't live without.
My mortgage calculator. Yeah.
Yeah, I knew you were going to say that.
Yeah.
Industry trends you are noticing.
People are sitting on the sidelines waiting for rates to come down. And if they wait much longer, they're going to be sorry. Because as soon as rates do come down, we truly, the industry gurus believe in our bones it's going to be mayhem in the real estate market. Because we have the biggest pool of qualified buyers ever in history. And on average, the millennial is living in mom and dad's basement with their spouse, and they haven't bought. So as soon as rates are coming down, everyone's going to go out there. Purchase prices are going to go up. So my advice, you're marrying the house, you're only dating that rate. Get in now, ASAP.
That's
we'll refi you.
That's a slogan right there.
Mm-hmm.
Say that one more time.
You're going to marry the house, you're only dating that rate.
That's tight. I like that.
Mm-hmm.
So, and it's funny you should say that. So 25% of our potential customers are young adults, married or single, that want to buy a property and can't afford to, so they're building an ADU on mom and dad's or whoever's property. It's fascinating. It really is.
It is. The dynamics are changing. And I did it. I did it 20 years ago. I built
You
a
know
house
what?
with an
Honestly,
in-law.
I think it's at the end of the day, I think it's better for everybody.
It
It really is.
I mean, the rest of the world does generational living. We're just
100%.
late to the game.
Yeah, I think it was just it was just different,
Yeah.
right? In the 70s, 80s, and 90s, even 2000s, it was different, right? You went and bought a house. And if it was a half an hour away or 45 minutes away, it didn't matter. Because obviously everyone, generally is pretty healthy. And now all of a sudden we're all getting old. Not me,
Funny
but
thing about
everybody
that.
else.
Yeah. I'm with you. We're both still 21.
Exactly. In my mind, anyways.
Yes.
Let's see. Dream project you'd love to work on. Can be anything. Dream project. Not even just the mortgage world. Just
Well,
dream
can I tell you about a dream project I just did?
Okay, sure.
Okay. So I just built what I call the Mac Daddy of patios in my backyard.
Mac Daddy.
Yes, also known as Kathleen's 19th hole. So took out the deck, put in a big stone patio with a fire pit and a wraparound bench.
Wow.
And a complete outdoor kitchen.
Nice.
And roof with heat lamps so we can watch the Pats. Skylights and fans. There's a television. There are 10 Adirondack bar chairs going
Awesome.
around. So it's fun.
All right, so that one's off the bucket list.
Yes, done.
All right, best piece of advice you've ever received.
Back in college, I went in undecided. And my advisor, right away, he happened to be the vice president of the college, and he sat me down and he said, what do you want to do? I said, I know I want to do business, but I'm not sure what to major in. He says, I'm going to tell you this. He says, you got a 98 on your entrance exam here for English. He said, so I'm going to tell you to major in English. I said, English? If I want to go into business? He said, yes, because with business, you're going to have stats classes and all kinds of things that are not usable tools once you leave campus. He says, you need to be able to talk effectively, you need to be able to negotiate, you need to be able to prove a hypothesis, and that's what you do in English. He says, and most importantly, you need to be able to write a proper business memo, now email, and I would say that's the best advice I ever got. It's usable skills.
Yeah, 100%. It's funny, so I'm going to the Stonehill College tonight. Every month they have an entrepreneur club there.
Nice.
And I just go as a visitor, but occasionally they'll, because I'm obviously the oldest person there. And
you're only 21.
Yeah, well, in dog years.
Yeah.
And it's interesting. It's just, I love it because I get to see all these college kids and hear their ideas and what they're saying. So it's really fun for me, and I go with my youngest son, and now my younger daughter is actually at Stonehill now. So. She'll be coming as well, so it's a lot of fun. And,
that's fantastic.
Yeah, I really love it, but I'm going to share that story.
Okay.
How are you using AI within your business, or how are you seeing AI?
AI is, we're actually having classes on it internally at Fairway. It is changing things drastically, and when we approve a loan, we have to run it through an automated system with Fannie Mae, Freddie Mac, or with HUD, FHA loans. And they spit out for us whether we're approved or denied or referred or and the criteria that we need to collect from the borrower. So documentation. Now AI is going through, we're pulling bank statements right from your bank, and they're seeing the deposits for income, and they're seeing the assets, and we're able to, in some circumstances, waive needing to get all of those documents from you. If you're a straightforward W-2 salaried employee.
Super clean, yeah.
Beautiful. And in some cases, we don't need an appraisal too. So things are changing.
Wow. Advice you would give your younger self?
Don't stress so much.
Yeah.
Enjoy it.
Easier said than done.
Take a minute and enjoy life. Yes, it goes by very quickly.
Easier said than done. Favorite food and dessert?
Okay, so I love a good steak. I love a good pizza, so now I'm going to have to go get a triple bypass. No, I'm just kidding. Favorite dessert, ice cream, all the way.
Any particular flavor?
No, I mix it up, but...
Any brand? Everyone's got a
Giffords.
favorite. Really?
Yes.
Haven't heard that one in a while.
Yes, Moose Tracks. Yeah.
Oh, Moose Tracks, Giffords, all right. Yeah. If you could have dinner with anyone alive or dead, who would it be?
Here we go. Yeah. It changes throughout the years when I've got this question before.
You never had this much fun, though, doing it.
No. So maybe go back and talk to one of the founding fathers of America. I would love to have that dinner and say, you're never going to guess what happened. So.
Well, we couldn't tell him because it would spoil it.
I know. Yeah.
Yeah, I often think of that one. I obviously I'm, very interested in the Constitution, and I often say to myself, it would be fantastic to be able to go back and say, what were you thinking when you put that comma in?
Right.
What's that comma for? What do these words mean to you? What's driving you? What life happenstance happened to you all that you've agreed that these words have to be constructed this way?
And what would you think of what we've done?
Yeah, that'd be fantastic. All right, last one.
Okay.
If you had $10 million to donate, who or whom would you give it to?
Oh, that's easy. I already know. So I have a special needs sister, and I would buy her have you build a beautiful home, completely handicap accessible for her and her roommates, and make sure I hire the best staff that are being paid very well to take exceptional care of these beautiful people.
Amen. That's a wrap for today's episode of the BuildX Podcast. Thanks to Kathleen Caddell from Fairway Home Mortgage for joining us. Please subscribe, like, and share if you've enjoyed it. See you next week. And remember, Kathleen, just build, baby.
Thank you so much. It's been a pleasure, Buzz.